the situation in China is dire. While US stocks are reaching all-time highs, Chinese stocks have plummeted, shedding over $6 trillion since their peak in 2021. The relentless sell-off has made China the worst-performing major market this year. Tokyo has even surpassed Shanghai as Asia's largest equity market, signaling a significant shift in economic power dynamics. The repercussions extend beyond the stock market, impacting the local asset management industry with the closure of the highest number of mutual funds in 5 years. Comparing the CSI 300 index to the MSCI World Index reveals the extent of China's economic woes. The country's biggest companies have suffered significant losses amid this massive sell-off. Even more alarming is the Hang Seng P/E ratio, which now sits lower than the Nasdaq's price-to-book ratio, underscoring the severity of the situation. As experts analyze the data, it's evident that China's economic landscape is undergoing a turbulent transformation. Several factors contribute to China's worsening unemployment crisis. Firstly, there are substantial deflationary pressures resulting from an exceedingly sluggish post-COVID-19 recovery. This sluggishness has hindered job creation and economic growth, exacerbating the unemployment problem. Additionally, geopolitical tensions and regulatory crackdowns have created uncertainty among investors, further destabilizing the market. As the storm clouds gather over China's economy, finding a path to recovery becomes increasingly challenging. So, unlike the US, China has really struggled to revive its domestic demand for goods and services after tough lockdown measures. This situation has caused widespread deflation in the Chinese economy. Consumer prices have now marked their longest streak of decline since 2009, with the Consumer Price Index falling 0.3% in December from a year earlier. It was reported in Bloomberg last week that China's economy-wide prices are in their longest decline since 1999. A measure calculated by Bloomberg using the difference between nominal and real GDP growth contracted for the third straight quarter in Q4 of 2023. The people simply aren't spending their money, and Chinese businesses are really feeling the pressure. Free gate pricing, which is the pricing for goods and services quoted by the manufacturer before any taxes, shipping, or other fees are added, fell 2.7% in December after a 3% fall in November. These prices have now been on the decline for more than a year thanks to lower commodity prices and weak demand locally and abroad. In fact, Chinese exports fell 4.6% over 2023, which marks the first annual drop since 2016. A worrying statistic considering just how much of a pillar exports are to the Chinese economy. The value of Chinese exports is also in decline, making them cheaper for foreign consumers. In October, the index of export prices hit the lowest level in data going back to 2006 and was only slightly higher in November. Food prices in China have also fallen, now for 6 straight months. And all in all, the ongoing deflation everywhere in the economy is leaving economists wondering if any meaningful stimulus from the government will ever arrive. Yes, indeed, you heard correctly. While many countries worldwide are currently maintaining high interest rates to cool down their economies, China finds itself in the opposite scenario. The country's central bank has pledged to intensify macroeconomic policy adjustments to bolster the economy and stimulate a rise in prices. However, the global community is still awaiting substantial action from the CCP. The crux of China's challenge lies in its persistently weak domestic demand, which consequently results in subdued prices across the economy. Despite rhetoric about enhancing domestic consumption, the Chinese authorities repeatedly fall short in implementing measures that would effectively boost demand. Raymond Jiang, chief economist for Greater China at AZES, succinctly captures the essence of the issue. China needs to act boldly to break the deflationary cycle. It will fall into a negative spiral otherwise. This highlights the inherent danger of deflation, as it can exacerbate economic woes if left unaddressed. Japan's experience during the 1990s serves as a cautionary tale, where prolonged deflation led to a downward spiral of production, wages, demand, and prices. Hence, economists emphasize the urgency for the Chinese government to intervene and provide significant support. Many anticipate that such support will come in the form of interest rate cuts. However, the Chinese government may have alternative strategies in mind, despite widespread expectations for the People's Bank of China to reduce the rate on its one-year policy loans, known as the Medium-Term Lending Facility, to 2.4%. The anticipated rate cut would have been the first since August 2023. The divergence between expectations and actions underscores the complexities of China's economic policy landscape. The central bank's decision to leave interest rates unchanged left analysts baffled. considering the pressing concern of deflation that urgently needs addressing by the Chinese government. It's evident that some form of stimulus will be necessary, especially when examining the recent shocking economic data. China's economy did experience growth in 2023, with GDP rising by 5.2%, an improvement over 2022's 3%. However, excluding the pandemic years, this performance marks the lowest growth since the 1990 recession. On a quarter-by-quarter basis, GDP grew by just 1%, slowing from a revised 1.5% gain in the previous quarter. Upon delving into the details, several concerning indicators emerge, particularly regarding the real estate sector. A significant shift in government policy from supporting the debts of major property developers to allowing them to go under has raised questions about the future of the property market and the overall economy's health. Dozens of private developers have collapsed, exacerbating the challenges facing the property sector. China's December new home prices fell at the fastest pace in nearly 9 years, marking the 6th consecutive month of declines. The decline in property sales and new construction highlights the subdued demand and financing challenges confronting debt-ridden developers in China. These factors exacerbate deflationary pressures within the economy, yet there appears to be a lack of response to the concerning data. Addressing leaders at the World Economic Forum this week, the pressing need for decisive action to tackle these challenges cannot be emphasized enough. The gravity of the situation necessitates urgent measures to stimulate demand, stabilize the property market, and bolster economic growth for sustained recovery. Chinese Premier Li Keqiang's assertion regarding China's achievement of their approximately 5% growth target for 2023 without significant stimulus measures is noteworthy. However, the choice of phrasing is intriguing, considering the palpable frustration brewing among citizens, economists, and investors due to the apparent lack of action by the CCP on the stimulus front. This sentiment underscores a growing concern regarding the effectiveness of China's economic policies and the urgency for more robust measures to address the challenges faced by the economy. Additionally, the recent release of economic data reintroducing reporting on China's youth unemployment rate further highlights the complexities of the economic landscape, with youth unemployment peaking at 21.3% in the middle of last year, equivalent to 1 in 5 individuals aged 16 to 24 facing unemployment. The situation is concerning. This resurgence of data sheds light on the significant hurdles faced by younger demographics in accessing employment opportunities, adding another layer of urgency to the call for proactive measures to stimulate job creation and economic growth. What made the situation even more peculiar was the abrupt discontinuation of reporting on youth unemployment by the CCP. The government cited plans to revisit the methodology, but analysts view the suspension as part of a worrying pattern of opacity surrounding the true state of China's economy. At the time, China was being compared to countries notorious for their youth unemployment rates, such as Spain and Italy. The prominence of youth unemployment in headlines is due to the fact that these individuals represent the economy's best workers with high levels of education and productivity potential. Therefore, skyrocketing youth unemployment indicates a significant underutilization of valuable human capital. The underlying reasons for younger workers not finding employment stem from the broader economic slowdown. Businesses are hesitant to hire fresh talent amidst struggling economic conditions. Additionally, there is a mismatch between the growing number of college graduates and the available jobs in the service sector, which is the primary employment sector for young Chinese. The Chinese government's emphasis on university enrollment has led to a surge in graduates, yet job growth in the service sector has not kept pace, exacerbated by CCP policies and the pandemic's impact. Furthermore, the CCP's response to the crisis has focused on increasing recruitment in the civil service and expanding postgraduate enrollment. However, investments in infrastructure and stimulus-driven opportunities in sectors such as carpentry and bricklaying hold little interest for graduates in fields like literature and computer science. President Xi Jinping's message to China's unemployed youth to eat bitterness reflects a government approach that prioritizes social stability over addressing youth unemployment concerns. In the latest economic release, the CCP reported that youth unemployment, excluding students, was around 14.9%, showing some improvement from the midpoint of last year, but still indicating room for progress. Overall, deflationary pressures, a faltering real estate sector, and a youth unemployment crisis are key areas of concern for China's economy in 2024. The government's preference for resilience over meaningful stimulus raises questions about the economy's trajectory. As we look ahead to 2024, the fate of Chinese stocks remains uncertain. Will they continue to decline or have they hit rock bottom? Let us know in the comments section below. Also, don't forget to hit the like button and subscribe to our channel